Welcome to my channel, where I talk about AI, tech, and stock market daily. Today, I wanted to dive into one of the hottest debates right now. Is it better to invest in cryptocurrency or the tech stock giants, known as the Magnificent Seven? If you're following the latest investment trends, you've probably heard these big names come up often. The Magnificent Seven tech stocks, which include Apple, Amazon, Microsoft, Alphabet, Meta, Nvidia, and Tesla, are reshaping the technology landscape with their innovations. At the same time, the cryptocurrency market, led by Bitcoin and Ethereum, offers the allure of decentralization and rapid gains, though it has also faced significant volatility. In today's analysis, I'll look at both sides, comparing the risks, potential rewards, and stability factors between crypto and the tech giants. We'll consider each option's growth potential, how recent events in both spaces affect your decision, and which might align better with your financial goals. By the end, you'll have a much clearer picture of the pros and cons of both paths in today's market. Let's explore the Magnificent Seven tech stocks, a major force in the U.S. stock market. These seven stocks accounted for over 30% of the S&P 500's gains this year. Apple, with a $3 trillion valuation, leads in market influence. Nvidia's AI advancements are crucial for machine learning, while Microsoft Azure is a top cloud provider. Despite economic shifts, these companies consistently deliver growth and innovation. Microsoft and Alphabet reported strong financials, highlighting their market resilience. Their foothold in essential services like cloud and advertising helps weather downturns. Leveraging AI and EV tech, these giants continue to expand and innovate. Let's talk about the elephant in the room risk. While tech stocks like the Magnificent Seven carry inherent risks due to their high valuations and dependency on innovation, they generally come with lower volatility than cryptocurrencies. Investors in these stocks usually expect long-term growth fueled by continuous product development, brand loyalty, and well-established revenue streams. These companies have extensive cash reserves as well, providing a financial cushion. Take Apple, for instance. Its cash on hand of around $63 billion as of Q3 2023 allows it to make bold investments or even return capital to shareholders through dividends and buybacks, creating a safety net that most cryptos don't have. Now let's switch over to cryptocurrencies. Bitcoin and Ethereum are the two giants in this space, holding the majority of the market cap within crypto. Unlike traditional tech stocks, these digital assets aren't tied to quarterly earnings, product launches, or a central organization, which means they don't follow the typical fundamentals of valuation. Instead, their values are influenced by demand, regulatory news, and the level of adoption in global markets. Recently, the cryptocurrency market has seen a resurgence, with Bitcoin climbing back to around $76,000 in October 2024, a big jump from its low of around $15,000 in late 2022. This resurgence is partly driven by the Bitcoin ETF approvals, which is bringing more institutional capital into the crypto space. Cryptocurrencies have high potential returns, but they're extremely volatile. A prime example is Bitcoin, which soared from under $10,000 in early 2020 to nearly $70,000 by late 2021, before plummeting to around $16,000 in the following year. This kind of volatility can be nerve-wracking, and the lack of regulatory clarity in many parts of the world adds to the risk. Yet, it's this very volatility that also attracts investors. Many people see crypto as an asymmetric bet, one where the potential gains far outweigh the capital at risk. Ethereum, for instance, has drawn attention with its decentralized application capabilities, smart contracts, and the boom in decentralized finance, or DeFi, all of which contributed to a rise in value that once peaked above $3,000. Another factor to consider is the underlying technology and its trajectory. Blockchain technology, which underpins cryptocurrencies, has increasingly been adopted in industries ranging from finance to supply chain logistics. Ethereum's blockchain, in particular, has become a platform for a vast number of decentralized applications. In contrast, Bitcoin is seen more as a digital store of value, often referred to as digital gold. There's a growing narrative that Bitcoin could be a hedge against inflation, similar to how gold has historically been viewed. This perception was reinforced when Bitcoin prices rose in response to inflationary pressures globally over the past couple of years. However, it's worth noting that cryptocurrency is still in a regulatory gray area in many regions. The United States Securities and Exchange Commission, or SEC, has cracked down on some cryptocurrency exchanges, which raises questions about the future of crypto regulation. In contrast, the Magnificent Seven are well-regulated entities under U.S. law. which makes them a relatively safer option in terms of regulatory risk. That said, many advocates argue that regulatory clarity could actually benefit crypto by reducing uncertainty and potentially increasing adoption. Consider accessibility and liquidity. Stocks offer a liquid, regulated market for easy trading. Cryptos are less liquid, with 24/7 trading and sharp price shifts. Spot Bitcoin ETFs could enhance crypto liquidity. Crypto offers diversification, sometimes uncorrelated with markets. In 2020, Bitcoin surged despite the pandemic's impact on traditional assets. So where does that leave us in terms of making a decision? For growth in a safe zone, the Magnificent 7 tech stocks offer a proven track record with lower volatility. Cryptocurrency, however, offers high risk for potentially outsized rewards. Bitcoin's limited supply is often cited for its long-term value. As institutional investors warm up to crypto, demand may drive prices up. In conclusion, if you're weighing crypto versus the Magnificent 7, it ultimately boils down to your risk tolerance, investment horizon, and belief in the future of either decentralized finance or traditional tech growth. Tech giants offer relatively steady gains, driven by constant innovation, strategic acquisitions, and established products. Meanwhile, cryptocurrency offers an exciting, albeit unpredictable, growth opportunity for those willing to ride the waves of volatility. Balancing both might also be a strategic approach, using the stability of tech stocks as a foundation while exploring the high reward potential of cryptocurrencies as a small part of a diversified portfolio. If you enjoyed my analysis, please subscribe to my channel. Thank you, and see you next time. Remember, markets shift constantly, so keep a close watch, do your own research, and consider consulting a financial advisor to align your investments with your long-term goals. This information is for reference and not financial advice, as I am not a licensed financial analyst or advisor.